Hey traders, I just want to bring your attention to the Australian dollar versus the US dollar. As you can see here, as a result of last week, we're continuing the US dollar's strength, and this is sending the Australian dollar down. Just how far down is anyone's guess. However, we do have good evidence to suggest that we will see the Australian dollar potentially turn around or indeed see some profit taking and see some bulls coming into the market around about 0.7155. The reason behind this argument is the fact that this hard level of support has been tested once, twice. Will it happen a third time? Well, prices have been down below this level since the beginning of 2016. So that's well over 2 years or even 2.5 years ago. So if you can reasonably conclude from a supply and demand perspective, if the Australian dollar hasn't been as cheap as it has been for over 2.5 years, you can reasonably expect buyers to come into the market looking to essentially buy low. That is a key tenet of investing. So this is a pretty good or strong floor, should I say, in the way, potentially obstructing price from going any lower if, as and when the Australian dollar does fall in around this level. Okay, but this isn't the only reason, by the way. We do have the completion of a harmonic free wave ABCD pattern projected at that level as well. So as you can see here on the daily time frame, not only are we making lower highs and lower lows, and of course we've had this retracement from mid-May all the way to the current first week of June, but now this has served merely as a complex retracement in a downward trend. As you can see here, this downward trend has been formed ever since we've had the confirmation on the daily with the 20 below the 50, the 50 below the 200, and now we've got that great fanning of the 20 below the 50 and the 50 below the 200. Order, angle and separation, we've got good separation as you can see here, and the order is certainly there, and they are in the right order. So taking a look at this ABCD pattern, some of you might know it as the Thunderbolt. We've got point A here, B here, C, but D, if we get our Fibonacci extension tool and drag it from point B to point A, we can see that we've got perfect alignment of the 1.618 Fibonacci extension and the said level here. There we go, like we just mentioned, this level of demand where we can reasonably expect buyers come into the market. So this represents point D, or the forecasted point D, where we can expect buyers to come into the market. As you can see here, we've got a very similar level of momentum from point A to point B. We've got a lot of movement in a very short space of time, and it looks like we could potentially have it again when we're looking at point C to where we project point D to be at this level. So how can we take advantage of this? Well, there are a couple of options which might take your fancy depending on your level of risk adversity. What you could do is simply, if you do subscribe to the notion of supply and demand, you could have your order, this is a high risk trade by the way, have your order to buy on this horizontal level with your stop loss 100 to 200 pips away depending on how aggressive you want to be. This will essentially get you in the move if, as and when price does come down to test the level. Of course, it could come blazing through like a hot knife through butter, and this is why a lot of people prefer to wait for a price action based confirmation instead. So those people who want a slightly more cautious entry, please bear in mind that we will be trading this as a reversal regardless of whether we'll be trading it by buying on the level or waiting for a price action based confirmation. If you wanted the price action based confirmation, then what would make sense is a false breakout in the form of a bullish pin bar reversal on the weekly or the daily, preferably the former. The weekly is a much stronger time frame than the daily, and we can get much more clarity from it. But if we do get that tail below the level and the open and close above it, then that will represent a false breakout or indeed a bear trap, as some of you might know it as. So we would look to trade the break of the high if we do get the formation of a bullish pin bar reversal. But that said, you do have the choice of two options, and like I hinted earlier, this would be trading as a reversal. So remember that reversals carry much more risk than typical trend-based plays, but for the risk, for those reversals that do work out, there's certainly a lot more reward. Okay, so that concludes the Aussie dollar.